Picture this. A co-working company IPOs, its stock craters by nearly 40% within weeks. And then it quietly delivers one of the strongest earnings beats you'll see from any small cap this year. That's JustCo Holdings, ticker JCO on the Singapore Exchange. In this video, we're breaking down whether this hated IPO is actually a hidden value play using the JC Fund's own investment framework. Let's get into it. Here's the number that got our attention. JustCo's entire market capitalization, what the stock market says the whole company is worth, is about 313 million Singapore dollars. Now strip out the cash sitting on its balance sheet, $217 million, actual cash with no debt. Subtract that from the market cap, and you're left with roughly $97 million. That's what the market is charging you for the entire operating business. Over 50 co-working centers across 12 cities, generating close to $174 million a year in revenue. When a stock is priced barely above its own cash pile, that's either a red flag or an opportunity. Let's find out which. So what actually is JustCo? It's Singapore's largest homegrown flexible workspace operator. Think co-working, but across a whole ladder of brands. There's a collective at the luxury end. JustCo itself is a flagship and the boring office for budget-conscious customers. Founded back in 2011 by Kong Wan Sing, the company has grown to more than 50 centers spread across 12 cities in Asia-Pacific, from Singapore and Tokyo to Melbourne and Bengaluru. It listed on the Singapore Exchange's main board on May 22, 2026, as the first pure-play flexible workspace IPO on that market. Let's talk about how this business actually makes money, because the model is simple once you see it. JustCo is basically a sub-landlord. Step 1, it signs long leases, 3 to 10 years, on office floors in prime business districts. That rent is mostly fixed, locked in years in advance. Step 2, it renovates a space and relets it in much smaller, much more flexible chunks. A single desk for a day, all the way up to a private office for a year. The profit is a spread. What members pay per square foot, minus what JustCo pays a landlord per square foot, multiplied by how full the space is. That's why occupancy and something called cash EBITDA margin, basically cash profit as a percentage of revenue, are the two numbers management watches most closely. Who's actually behind this company? 3 names matter here. First, Kong Wan Sing, the founder and now executive chairman and CEO, who grew JustCo from a single center in Singapore back in 2011 to more than 50 centers today. Second, JIC. That's Singapore's sovereign wealth fund, one of the largest institutional investors in the world, which became a strategic investor back in 2018. And third, Frasers Property, backed by Thailand's TCC Group, which brings deep property and landlord relationships to the table. Together, GIC and Frasers made a joint commitment of about $177 million when they came on board. Let's walk through the IPO story, because it's been a roller coaster. May 15, 2026, JustCo prices its IPO at 94 Singapore cents a share, more than 3 times oversubscribed. May 22nd, it debuts on the SGX and falls 17.6% on day 1. June 21st, the bank supporting the stock price during the first 30 days stops buying, and the stock keeps drifting lower. July 10th, a big anchor tenant deal with Deloitte at a new Orchard Road location sends the stock up 7.4% in a single day. August 6th, JustCo reports its very first results as a public company, and it's a big beat, which we'll get to next. And as of August 11th, the stock sits at 64 Singapore cents. Still down almost 32% from the IPO price, but well off its lows. Now here's the headline number of this whole video. In its first ever results as a public company, for the 6 months ended June 30th, 2026, JustCo delivered revenue growth of 24% year over year, hitting $80.8 million. But the real story is cash EBITDA, that cash profit metric we mentioned earlier, which shot up 145.6% year over year to $10.6 million. That pushed the margin from 6.6% to 13.1%, more than doubling in a single year. And the bottom line net loss narrowed to just $0.8 million, down from $1.7 million a year before. This is not a small improvement. This is a company hitting an inflection point. So why are margins exploding like this? 3 reasons. First, occupancy keeps climbing, up from 78% to over 84%. Because rent is a fixed cost, every extra point of occupancy flows almost straight through to profit. Second, the portfolio is maturing. Centers that have been open for a while are simply far more profitable than newly open ones, and most of JustCo's estate has now crossed into that mature, profitable phase. And third, JustCo is shifting more of its growth toward management contracts, where it operates a building for a fee instead of taking on the lease risk itself. That's a lower risk, more capital-light way to grow. What's next for growth? Management's plan is to take the portfolio from 50 centers to 78 by the end of 2026. That's 28 new centers in a single year, and they reiterated in the August results that this is on track. Longer term, the so-called Vision 2029 targets more than 100 centers across 20 cities, roughly double today's footprint. There are also 2 brand new growth levers. The JustCo app, which lets people book a desk or meeting room on demand without a monthly membership, and JustAt, a new co-living residential brand launching in January 2027. And on top of all that, Deloitte Singapore is pre-committed to 100% of JustCo's new flagship location on Orchard Road, a strong signal of enterprise demand. How does JustCo stack up against its competitors? Let's look at some key valuation ratios. On EV to sales, enterprise value divided by revenue, JustCo trades at 0.47 times, compared to 2.31 times for the global giant IWG, and 2.36 times for Servcorp, a smaller, more mature operator. On EV to operating profit, JustCo is at 3.5 times versus IWG's 5.75 times and Servcorp's 9 to 10 times. Across almost every multiple, JustCo looks cheap, but there's a catch we need to explain. What actually protects JustCo from competition? Its so-called moat? For things. 1. That 3-tier brand ladder we mentioned lets it capture everyone from budget-conscious startups to luxury enterprise clients under one roof. 2. The dual operating model. Traditional leases where it wants full control and capital-light management contracts to scale fast elsewhere. 3. Those deep-pocketed anchor shareholders, GIC and Frasers Property, which bring credibility and landlord relationships that smaller rivals simply can't match. And 4. This one's important. JustCo carries 0 bank debt. Compare that to global giant IWG, which carries about $7 billion of net debt. That's a real structural advantage. Now let's play devil's advocate, because no investment thesis is complete without the risks. First, a lease versus member duration mismatch. JustCo signs leases for 3 to 10 years, but members can walk away in months. So a demand downturn could leave JustCo paying fixed rent on empty desks. Second, there's ongoing litigation in Melbourne, where a former landlord's counterclaim, following a 2024 diesel fuel leak, is now precisely quantified at $3.5 million, and it's still unresolved. Third, related party overhang. GIC and Frasers Property sit on both sides of many of JustCo's leases, which means governance needs constant, active oversight. And fourth, geopolitical exposure. About 10% of revenue comes from Taiwan, a risk the JC Fund actively watches given rising cross-strait tensions. So we've established JustCo looks cheap on paper. Let's dig into why. On our estimate, JustCo trades at about 3.1 times its projected 2026 cash EBITDA. IWG, the global leader, trades at 5.75 times. Servcorp, a smaller but more mature, profitable operator, trades at 9 to 10 times. In other words, JustCo trades at roughly a third of Servcorp's multiple. Why does that matter? Because Servcorp is arguably the best template for what JustCo could become: mature, profitable, and paying a dividend. If JustCo can execute anywhere close to that path, there's a real case for its multiple to re-rate higher. Let's put an actual number on what JustCo might be worth. We built a discounted cash flow model. a standard way analysts estimate what a company's future cash flows are worth in today's dollars. Instead of using a standard profit measure, we use that cash EBITDA metric because it already accounts for JustCo's real cash lease payments, which matters a lot given how lease-heavy this business is. The result: an intrinsic value of about $1.57 Singapore per share. Compare that to the current price of 64 cents, and you get an implied upside of nearly 145%. That's a big gap, and we want to be upfront that a number this wide should be treated as a scenario, not a confident prediction. Here's where it gets really interesting. Instead of just calculating what we think JustCo is worth, we flipped the model around and asked, what is the market actually pricing in today? The answer: an implied discount rate of about 31%. To put that in context, a normal, healthy company might trade at a discount rate closer to 9 or 10%. A 31% discount rate is the kind of number you'd expect for a company the market considers deeply distressed or extremely high risk. And here's the punchline. Even after that strong earnings beat we just walked through, this number barely moved. The market, for whatever reason, has not yet given JustCo credit for its improving fundamentals. So how does JustCo score against the JC Fund's own investment framework? We run every stock through 3 engines. Engine A, dividend growth. This one's a clear fail. JustCo pays no dividend and has no fixed dividend policy. Engine B, global growth. A mixed result. It fails our strict margin and growth thresholds, but it passes our balance sheet and liquidity tests with flying colors, thanks to that large net cash position. And Engine C, tactical alpha. This one fits well. JustCo looks like a classic asymmetric, cash flow protected setup. Exactly the kind of opportunistic, smaller position the tactical alpha sleeve of the JC Fund is designed for. So what's the bottom line? We'd sum up the JustCo thesis with an old value investing phrase: heads I win, tails I don't lose much. On the downside, the stock is cushioned by a net cash floor worth roughly 70% of its market cap. That limits how much you could realistically lose, even if things go wrong. On the upside, there's real potential tied execution on a growth and margin story that this first set of public results has now started to prove out. That combination, limited downside, real upside, is exactly why we frame JustCo as a tactical, position-size cap holding, not a core, bet-the-farm allocation. Before we wrap up, here's what we're watching next, both for and against this thesis. On the bullish side, the H2FI 2026 and full-year results, confirming that 28 new centers pace continues, additional anchor tenant wins beyond Deloitte, the initiation of a dividend policy or share buyback, and JustCo finally picking up its first sell-side analyst coverage. On the bearish side, further lockup expiries that could pressure the free float, an adverse outcome in that Melbourne litigation, a Taiwan or cross-strait geopolitical shock, and execution slips as JustCo pushes into new markets like India, Hong Kong, and Malaysia. Any one of these could meaningfully shift the picture. One last thing before you go. This video reflects JC Fund's internal research process and is for educational purposes only. It is not a recommendation to buy or sell any security. JustCo currently has 0 sell-side analyst coverage, so please do your own research and speak with a licensed financial advisor before making any investment decisions. If you found this breakdown useful, hit subscribe. We'll be back with more deep dive investment breakdowns just like this one. Thanks for watching.